This is a download from BFM 89.9, the business station.
Morning, Dodge. The Fed is currently weighing the pros and cons of either keeping or lowering its unemployment threshold at 6.5% before raising interest rates. Will this actually help the economy, or will this develop into another asset price bubble?
Good morning, Julian. Lowering the Fed's unemployment threshold in conjunction with cutting the bond buying and relying more on forward guidance, that's the combination that will help the Fed program get closer to what it's trying to do with regard to economic improvement. The bond buying does boost asset prices. Well, at least it lends support and doesn't allow asset prices to go down based on economic demand. Also, the Fed balance sheet has been expanding. At some point, that needs to be reversed. In the meantime, bond buying will continue to have less and less effectiveness in its utilization. It really doesn't help the improvement that we need, which is really more in employment quality and employment participation, particularly participation. Participation has been particularly troubling, and we need to see an improvement in participation so that it will help in consumer demand. Forward guidance will help us with the transition.
And consulting firm McKinsey issued a research report saying that it is not QE that boosted stocks, but rather the rising profit and cash levels of companies. Do you agree with this?
No, Julian, I do not. Profit was not adequately analyzed in their study. As we reported throughout the year, the majority of the rising profit levels were caused by internal cost-cutting in response to less revenue growth rather than real growth. This includes full-time employment reduction in order to avoid Obamacare costs and more part-time workers. Our most recent household survey reflected a 230,000 plunge in employment in addition to the 507,000 workers kept home by the government shutdown. Also, private employment was down 9,000, and consumer sentiment slumped for the fourth straight month to its lowest levels since 2011. Corporate cash levels are high because there's little confidence in the consumer given the low employment participation. QE has lessened competitive alternative to stocks, and so therefore there's been a demand for stocks, particularly the high-yielding ones. It's really created a non-economic floor to our market pullback. In fact, if it continues long enough and our economy can start to pick up, we may traverse the period that we should have a market pullback or a bear market and look to the other side. So I completely disagree with their analysis and their conclusion.
And moving on to China, after initial disappointments, investors seem to cheer China's reform policies to introduce more market reforms and also loosening the one-child policy. Now, the iShares China Large Cap ETF rose 4.5% on Friday's trading and has bounced back some 26% from its recent lows in June. Tell me, Dodge, is this a new era for China?
Well, it's certainly starting out to be. I mean, China did announce its boldest set of economic and social reforms in 3 decades. The changes were sweeping on Friday. They were much more sweeping and much more comprehensive and specific than were felt that the market felt they were going to be back on Tuesday. The actual announcement dispelled doubts about the leadership's zest for reforms. They had a 60-point plan, specific policy plans covering a broad range from interest rate, currency regime liberalization to residence registration, land reforms, and the pledge to allow more competition. I mean, all this is really good, and it starts the plan off in very good shape. The establishment of a working group to lead economic reform and a new state security council, this indicates the effective consolidation of power in the first 8 months. But what we're going to be watching is not just the words, but the action. What happens, a conclusion. We have China has a deteriorating demographics that are likely to turn 3% off the nation's growth rate through 2030. What is going to be particularly important is a combination of effort. Success will require a politically left approach of tightening the political group, while at the same time an economically right approach to loosening economic control. Very tough to do. But I'm hopeful. If I had to bet now, I think it will take time, probably the 2020 that the government is indicating for results. But I'm hopeful that they will be able to put action behind their words.
Thank you. Dodger Dolan, Chairman and Chief Investment Officer of Lander and Fuse Capital Managers in New York, on this morning's Market Watch, BFM 89.9.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.